I've got a passion for building out a portfolio and keeping it.
I'm here meeting Daniel Hassibi the very first time. Daniel, where are you from?
I'm from Toronto, Canada.
Toronto, Canada. I used to live in Buffalo, New York. I remember we crossed the border to Toronto all the time. They have like the most amazing Chinese food over there. So what brought you over here on the U.S. side? Because you're not a U.S. citizen, right?
I'm not a U.S. citizen, but essentially what got me into the U.S. and my attention focus on the U.S. was real estate. I was expanding my portfolio across Canada, and then I saw more opportunities in the U.S., joined the SubTo community, and now being a part of Owners Club, it's got me more involved in the U.S. and different states as well.
That's great. The reason I decided to invite you to come over is do this podcast with me today is because you come from Canada. I think you can offer a very unique perspective coming from Canada, why you decide to invest in the United States, and then the difference in the legal issue you have to go through. So maybe let's go back to the beginning and explain to us, how do you start in real estate? Because I think that's the most important question people often ask. Why did you start in real estate? How did you start it?
Yeah, so I started off getting into real estate because I wanted to buy my mother her first home.
Oh, wow.
That was my motivation behind it. She gave up a beautiful life back home in Iran, and she was really supporting the household and doing what she could, but we didn't live in the best neighborhood. Yeah, very ghetto, very rundown apartment filled with cockroaches and rats. Like, that was sort of the upbringing.
And where was that?
That was in the east end of Toronto.
Okay.
Yeah. And so eventually, when I got to an age where I started making a little bit more money, I started saving all my money. And, just like the traditional way of buying real estate, you save as much as you can, and hopefully you've got 10%, 20% down. And so I did that. But what ended up happening was that I ended up taking advice from a mortgage broker at a bank who never took the time to understand what I wanted to do. And I got locked into a 5-year term. So in Canada, it's a lot different than it is in the US.
Maybe let's explain that real quick.
We've got 5-year terms that you can choose from for your mortgage before the renewal.
Is that that's when you have to be forced to refi? Is that?
You don't have to be forced to refi, but you do have to renew your mortgage. So you can go as low as 1 year or 6 months, 2 years, 5 years. We do have 10-year terms as well, but very seldom do people choose it.
I see. So I assume you have a shorter term will be higher rate?
Not necessarily. I mean, when you compare the rates to the U.S., our rates are typically lower than U.S. rates. But yeah, depending on the lender and depending on what rates you're choosing, also depending on your client portfolio determines what rates you're going to qualify for.
I see.
So I get into this product and I dump about $130,000 into renovating this single family home. And it was a full renovation.
All saving, all cash?
All savings, all cash. I put $80,000 down. It was 20%, $80,000 down. And then I dumped about $130,000 of my cash into this deal. So I was like depleted at this time. Everything I saved up. I tapped out. And when I went to refinance the property after 6 months, I didn't realize this, but the penalty of breaking the mortgage was going to wipe out all of my profits.
Whoa. So yeah, the early termination fee, they didn't explain to you that if you
They never took the time to explain that. So there was a 5-year opportunity cost where I had to sit on the sidelines and wait for this renewal to come up so I can start pulling the money out. Now, around this time, again, I started saving more and more money. And then I realized that while I was hoping that I can secure another property soon, people were buying apartment buildings every month. And these were people within the real estate community that weren't necessarily smarter than me or more hardworking.
Rich, yeah.
Or rich, but they were buying buildings. And here I was.
One house.
I'm hoping to buy one single family home. So I realized that there was something wrong. And then I started learning that there was different strategies. Now, I'll never forget, I was dating this girl at the time, and she said she actually joined a community very similar to that. And she said that I'm going to start buying properties every single month. And I found that really cute because she had no experience in real estate. And she kept saying, OPM.
What does that mean? Yes.
And so I remember just hearing it from her over and over and over. And I said to her, are you talking about like opium, the drug?
Yeah.
Like, do you want to sell drugs? And she goes, no, other people's money. And so when I started to draw the connection, I realized that there was something that I had been missing the entire time. Once I had learned that, it really propelled my buying strategies. Now, it wasn't until I joined SubTo where there was a whole different world exposed.
I know. It just kind of explain, kind of almost melt your mind a little bit. Like, I don't know, I get to apply that strategy even like quadruple it.
Yeah, now it's not just in the Canadian market, but I'm also amplifying those strategies creatively in the US. And you got to also keep in mind too, a single family home in Toronto, like the average price is 900,000 to $1 million. The numbers don't math.
But the rate is a little bit lower than what
The rate can be lower for sure,
but the term is also shorter.
but it's not just that. I mean, how much are you going to charge a single family to rent out a single family home? Whereas you can buy properties in the US for a fraction of
Fraction of that, yeah. So it sounds like there's no rent margin enough like benefit for people to kind of rent it, because it's going to be, in order for the landlord to make it profitable, they have to rent such a high amount. It just, the market wouldn't support, right?
It's very tough to make the numbers work. You have to go out of province, and that's something that I ended up doing for a lot of my clients that are investors as well too. They just can't find deals, and so now I'm starting to source deals for them across Canada and the US.
I see. Okay, so when did you start to come into US market, and what did you learn? What's the major difference?
So I actually got into the US market this time last year. So it was about July of last year where I joined SubTo, and then I just hit the ground running. For me, one of the things that I was able to identify early on was that each state had its unique attributes. For instance, Ohio's a cash flowing state, and you can't really bank on appreciation. Florida, you're not really going to see those margins of cash flow, but you will have appreciation. And so for me, what I found interesting was that I was able to stay within one country, the US, pick different pockets, which are different states.
Right, different geographic, depends on the market you want to invest.
But also balance out the portfolio between appreciation and cash flow. And so that was really allowing me to complement the portfolio that I had already built in Canada.
You do the syndication model, right? Every deal separately.
Yeah, I raise capital for every deal.
Okay.
Separately.
So you're obviously very eloquent. I can kind of just tell you're a capital raiser, so, right? But when you first started as a capital raiser, do you have to kind of overcome certain mental hurdles? Like, who am I? What am I here to talk about? Why would people give their money to me? Do you have to go through that?
Yeah, I don't know if I would say that I had to go through that, because I come from a sales background. I've been in tech sales for a long time. And so for me, I enjoy talking to people. Sales has always been a strong suit for me. But more so, I think the challenge became, what if it fails? Because on sales, when you work for a company, the
Not my product.
failure, it's not your product. And then the failure is you just get a no. But what happens if you raise someone else's capital, deploy it, and then it doesn't go right and you lose their money? And so for me, I had to get really granular on the math and really understand the exit strategies. And I always say this to people. I think the most important component of any deal that you ever get into, whether it's real estate, whether it's business, whether it's a relationship with your loved one, the biggest component that everybody seems to dismiss and forget about is your exit.
Correct.
And unless you have a defined exit, the entry is very easy to get in. It's the exit that allows people to really go through those downfalls because they haven't planned it properly.
Right. So that's a really great point. I've noticed that people sometimes they plan for that exit, but when the time comes, that original exit strategy wasn't really working. So when you plan for that, obviously you need to protect investors' money, right? Do you guys have multiple exit strategies, just like a backup plan?
Always. And one of the things that I always assure my investors is a contingency reserve backed by my own money. So I will go into a deal and I will always have a contingency reserve of $250,000 or more, depending on the size of the deal, where I say that if your money is not safe, it's not generating any sort of interest, the deal doesn't go the way it's supposed to, or somewhere along the lines the plan falls apart, my money's there to back it.
Okay, so when you say you back, is you coming to pay for extra, or you kind of guarantee their minimum return?
They get their principal, and the way that I structure the deals for my investors is that I will have a 12-month term with them, for instance, and if I refinance the property within 6 months, I'm still paying you out for 12 months.
I see. Minimum return.
Yeah. So they can always bank on receiving that interest that they were going to receive. And again, it all goes back to that opportunity cost. I never want my investors to feel like they're going to get a 15% return, but I only use their money for only 3 months.
I got
You're going to get 15% per annum with those full 12 months, like I said that I was going to give to.
That's very interesting. I've noticed that that's sort of like a bonus. That the way I look at it, a lot of capital raiser, that's how they attract capital, right? So yeah, if I finish project sooner, that's even better for you because you're still getting paid the return I promise you, like 6 or 12 months. Were you asking those capital from Canada mostly?
Yeah, a lot of my investors came from Canada, and then I started expanding in the US. The dollar really doesn't allow us to take money from Canada, bring it over to the US. There's a huge discrepancy. Like I had brought in 10,000 US for one particular deal in Ohio, but it cost my investor 14,700.
Right. The currency exchange back to that.
So it's not the best way to go about it. My investors in Canada, they typically stay in Canada with respect to investments, and then the ones in the US will go ahead and invest on the properties in the US.
I see. So you have capital raised from both sides.
For both.
Depends on the market. What would be the project you're most proud of? And then also give us another example that the project went wrong that you learned from it.
I'll start with the one that went wrong. There was a property that I had bought in a particular neighborhood where I had other properties that I had purchased. And my property manager was managing all those properties. And this particular property was going to be a fix and flip. And so he came in and he convinced me that he can do the job. Now, he was really good at managing the properties, but I wasn't so sure if he was able to manage a project. I still gave him a shot. And in the end, we had a cost overrun. The appraisal fell short, and that was a $100,000 loss that I had to incur. Now, that was investor capital. If that investor is watching this podcast, they'll now soon realize that I actually lost money on the deal, but that investor never heard about it because I backed.
You have a reward. Yeah.
I have the reserve. And so that was a learning experience for me, that just because someone's able to manage properties does not mean that they're able to manage the budget. Now, they were very good at managing tenants, but when it came to the actual budget, it wasn't their strong suit. And so I learned one of these lessons very early on that allowed me to become more granular in how I form relationships and vet them.
Yeah.
I think the greatest success that I've had really comes back to what I was able to do for that person. It's not so much the outcome of the exit, the outcome of the acquisition. It's how I made the person feel in that moment. And so this was a property.
For your investor, how they feel?
It wasn't just the investor. It was a family. It was right before Christmas.
Right.
They were living in a shelter.
Right.
And I was able to go ahead and acquire this home, provide affordable rents for them. And now a family, for the first time in years, was able to celebrate Christmas as a family together under one roof. And as a gift to them, we had bought a Christmas tree. They didn't have a Christmas tree. And so for them, it was one magical moment that they were no longer in a shelter. It was more about community for them.
Right. Well, that I can only imagine what kind of profound moment for them, because imagine they have like little kids when they move in. Right? When it's the very first time when they celebrate Christmas in their house.
Yeah.
With the Christmas tree. Yeah. That could really just completely change the person's entire trajectory of their life, where they're going. So kudos to that. Yeah.
I mean, look, you get into real estate to make money.
Correct.
But the intrinsic value is how you make people feel in the process.
Yeah. I think that's why you're so successful. Like, you can just really talk to people, identify what they want, and get the great opportunity. So that doesn't sound too bad.
Right.
You lost $100K, but I'm sure you can get it back.
Yeah, I mean, money will always come back to you.
Yeah.
But it's the feeling that you give to people. And I remember Pace Morby saying one time, he said that we do well so that we can do good for people.
Exactly. That's one of the quote I wrote down.
Me as well, too. Shout outs to Pace Morby.
There you go. Yeah, and he also mentioned that you have to make sure that your business is profitable so you can help more people. As simple as that. Like, especially if you put the good money in a person who had good heart, it could really just exponentially help more and more people. So it sounds like you're doing a lot of fix and flip remotely, virtually.
Not a lot.
Not a lot.
No, there's some fix and flips that we had got into just because the numbers made sense for it. I've got a passion for building out a portfolio and keeping it. Like, I like to tell people that I've got separation anxiety. I don't like to ever separate from my properties. My properties are my babies. So for me, I have a very strong buy and hold strategy. I like to buy single family, multifamily. We're now getting into the co-living space. Mobile home parks has been a huge interest of mine as well, too, especially with the fact that I've owned so much land over the years and I haven't done anything on them. And so that's another avenue that we're exploring. But for the most part, fix and flips will happen if the opportunity serves itself. I like to buy and hold.
Yeah. What's the longest holding period for the asset? I'm assuming you still hold them.
I still hold them.
Yeah.
Yeah.
How long was it before?
Oh, I'm like probably 10 years now. I'm holding on to my longest holding.
What about the Hassibi for your mom?
Yeah, so that's her house. I don't even look at it as mine. When I go and visit her.
The very first house.
That's the very first, yeah. So that's over 10 years. That's like 12 years now.
Okay. Cool. So now you buy only apartment building? fix and flip here and there?
Single family, multifamily, getting into mobile home parks.
Okay. Where are your core markets?
So we're across Canada. We're in New Brunswick. We're in Ontario. We are in Alberta as well too. Within the US, we're in Ohio, Florida, Georgia, and Texas.
Okay. All right. Well, that's great. So we're definitely going to list that in the podcast. So people are interested reaching out to you. How can they find you?
They can find me on Instagram. They can hit me up on Facebook as well. Name is Daniel Hassibi. I'm always responsive. Sometimes it does take a while for me to get back to my messages. I never try to leave anybody hanging. So if I ever get a message from anybody, I'm happy to help.
That's great. Well, thank you for doing this.